Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know: first, US cattle inventory crashes to a 75-year low, fueling sticky inflation and sparking a battle between ranchers and meatpacking giants. So we'll discuss why this supply shock complicates the Fed's inflation fight and what it means for potential antitrust action against food giants. Second, P&G's earnings beat masks a critical weakness, flat sales volume, signaling a split consumer and a potential peak in corporate pricing power. In this episode, we'll break down this divergence in consumer behaviour and what it signals for future S&P 500 earnings and retail sector health. Third, retailers abandon long holiday sales for short, targeted strikes, fighting a calculated consumer who is trading down to manage budget stress. Today, we'll take a closer look at this high-stakes retail battle and its implications for Q4 earnings and credit market stress. The US cattle inventory has just crashed to its lowest level in nearly 75 years. A primary driver here isn't just a typical market cycle, but a structural environmental shift. Persistent drought in America's Great Plains, a key cattle-producing region, is no longer a temporary weather event. It's becoming a long-term cost baked into the industry. This means the fundamental cost of raising cattle is rising, creating a higher floor for beef prices for years to come and reframing the entire problem as a climate adaptation challenge. That historic collapse is sending beef prices into the stratosphere, with steaks jumping 16.6% in the last year alone. Now, this isn't just about your grocery bill. This kind of food inflation is what economists call sticky. The shortage of cattle is a structural supply problem, not something the Federal Reserve can easily fix by raising interest rates to cool down demand. After all, monetary policy doesn't magically create more cows. This makes the Fed's fight against inflation, especially that difficult last mile, much more complicated. The sticker shock has become a major political problem. US President Donald Trump is now publicly demanding that ranchers get their prices down. But in a stunning turn, the ranchers are firing back, creating a firestorm in America's heartland. They argue the president is targeting the wrong people. The real issue, they say, isn't the farmer, but a massive consolidation of power. Now, get this. Just 4 corporations, Tyson, JBS, Cargill, and National Beef, now control over 80% of the entire beef processing market. Believe it or not, this situation is drawing intense attention to a powerful, if controversial, idea using antitrust laws to fight inflation. It directly challenges the greedflation narrative by reviving the Packers and Stockyards Act of 1921, a law designed specifically to prevent monopolies in the meat industry. When ranchers accuse these giants, they are essentially calling for a revival of this century-old law. One Yale University expert calls it what it is: consolidated markets gouging ranchers and gouging consumers at the store. The fallout is staggering. The US has lost over 150,000 cattle ranchers since 2017. One rancher, Mike Callicrate, put it bluntly, saying that until this market concentration is fixed, anyone would be a fool to get into the cattle business. This points to a breakdown in basic market logic. Normally, record high prices would signal ranchers to invest and expand, but that's not happening. We're seeing what some call a capital strike, where rancher confidence is so broken by the power of the processors that they are refusing to invest, suggesting the entire industry structure may be broken. But that's not the whole picture. The administration's proposed solution to import more beef was met with fury. This is where the situation takes a more complex turn, creating a classic government dilemma. On one side, the administration wants to lower consumer prices by increasing beef imports from countries like Argentina. On the other, it wants to protect domestic industries, announcing steep new tariffs on beef from Brazil. These conflicting signals create chaos and uncertainty for global markets. Even the National Cattlemen's Beef Association, a past supporter of Trump's policies, said the plan only creates chaos while doing nothing to lower grocery store prices. The core conflict is now out in the open. Ranchers feel squeezed between soaring costs and a market dominated by a handful of giants. As one cattle association head stated, the president is focused on symptoms, not the problem. So where does this go from here? The situation is complex, but a few key indicators will tell us which way the wind is blowing. First, keep an eye on USDA, cattle inventory reports, and the US drought monitor. Second, Watch for any DOJ or USDA announcements on antitrust investigations into the major meat packers. Finally, pay attention to US trade policy. These are the focal points that will determine whether your steak dinner gets more affordable or even more expensive. Disclaimer, this report is for informational purposes only and does not constitute financial or investment advice. Market conditions are volatile and subject to change. So, while ranchers are battling supply shocks and corporate giants, the fight over pricing power is also raging in every other aisle of the supermarket. That brings us to Procter Gamble. They just posted earnings that beat Wall Street expectations, but buried inside the report is a killer fact that tells a much bigger story. Sales volume was completely flat. This is a classic sign that a company's pricing power might be reaching its limit. For a while now, many big companies have kept revenues growing simply by raising prices, even if they weren't selling more stuff. P&G's report, with revenue up but volume flat, is a textbook example. This strategy can't last forever. If real consumer demand doesn't pick up, we could see a major squeeze on profit margins across the S&P 500. This means despite revenue climbing 3% to over $22 billion, the actual amount of products people are buying isn't growing. It's a stark warning sign, and P&G's own executives are sounding the alarm on what they call a K-shaped economy, which, describes a recovery where different parts of society move in sharply different directions. It's a tale of two Americas playing out in your shopping cart. CFO Andre Schulten revealed that while affluent shoppers are buying bigger pack sizes, consumers living paycheck to paycheck are stretching their money by using every last drop of shampoo and exhausting their pantry inventory before buying more. This behavior, which analysts call pantry destocking, is more than just being frugal. It's actually a powerful leading indicator of household cash flow stress. When large numbers of people delay purchases until their cupboards are bare, it signals severe budget pressure. If this continues, it could foreshadow a sharp drop in retail sales. Here's where it gets interesting. This is a perfect illustration of the famous lipstick effect. During uncertain times, people cut back on big ticket items but still treat themselves to small luxuries like premium skincare. P&G's data shows this split perfectly. Volume for its fabric and home care division fell 2%, but its beauty business, with high-end brands like Olay and SK2, saw volume jump 4%. One side of the economy is pulling back while the other is still spending on affordable luxuries. This situation presents a fascinating duality for the company. On one side, P&G just slashed its expected after-tax tariff costs in half, from $800 million down to $400 million, which is great news for its bottom line. But on the other, that stability may be short-lived. The updated forecast came just before reports that President Donald Trump is terminating all trade talks with Canada, a move that could send costs soaring once again. This highlights how corporate planning is becoming a hostage to trade policy volatility, making the Fed's job of stabilizing prices incredibly difficult. Procter Gamble may have posted its 40th consecutive quarter of organic sales growth, but its latest report reveals a consumer base that is fundamentally splitting apart, creating an unpredictable future for even the most stable household brands. This report is for informational purposes only and does not constitute investment advice. Market data is subject to rapid changes. Speaking of that splitting consumer base, this trend is forcing a massive rethink for the entire retail industry, especially as we head into the crucial holiday season. Let's start with a single statistic that might just change your entire perspective on this company. A new report reveals the average shopper made over 15 separate trips to stores last holiday season, but with one major catch: they bought less each time. This isn't casual browsing, it's a sign of a calculated consumer on the hunt, and major retailers are scrambling to adapt. This pattern of more frequent trips with smaller basket sizes is a classic behavioural signal of acute budget management. And the reason this is so significant is that this behaviour erodes retailer operating margins. Think about it. More transactions mean more fixed costs per sale, but total revenue doesn't necessarily go up. According to Kohl's chief marketing officer, customers are doing the work to get what they want at the price they want to pay, and that work is forcing a dramatic response. The CEO of Academy Sports and Outdoors notes that when they run the same promotion as last year, the take rate is significantly higher. Shoppers are waiting, watching, and pouncing on deals with surgical precision. However, if you zoom out, you'll see another layer of strategy at play. Retailers are fighting back by changing the rules of the game. That 10-day sale you were waiting for, The Academy Sports CEO says this year it might only run for 4 days. The era of the blanket promotion is ending, replaced by short, targeted strikes. So the thing is, retailers are waking up to the law of diminishing returns on discounts. Research shows that after a certain point, extending a sale doesn't bring in enough new customers to justify the cost. By shortening the promotion cycle, they're trying to create urgency and capture motivated buyers without giving away profits for too long. It's a high-risk strategy that could backfire on their Q4 revenue. This all points to a deeper conflict unfolding on the shelves. As shoppers feel the budget strain, they are actively trading down from premium brands to a retailer's own private label products. Coles executives say they are in a great position to capitalize on that. With 23% of Academy Sports business already coming from its private labels, the company calls them its best expression of value. Interestingly enough, this trade down effect has significant macroeconomic implications. When a large number of consumers shift to more affordable private label goods, it puts downward pressure on the prices of core goods, which actually helps to cool down inflation. It provides a tailwind for real income growth and could even give the Fed a reason to consider a more dovish policy stance sooner than markets expect. While executives from Dick's Sporting Goods to Coles describe the consumer as resilient yet a little bit stressed, their actions speak louder than words. And that word stressed is crucial. It points to an important economic signal that some analysts call spending bifurcation, a growing gap between the spending habits of high-income and low-income consumers. This divergence acts like a canary in the coal mine for the credit market, signaling a potential spike in delinquencies for store-branded credit cards and buy now, pay later services. This holiday season is shaping up as a high-stakes chess match where retailers are making surgical moves to capture every last dollar from a consumer who has proven they are willing to outweight and outsmart them.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.